Hello and good morning, listeners. Welcome back to Almus Market Mornings with Shikhar Garg, bringing in the latest financial updates. Folks, the global trade is one key factor for economic performances, and Asian nations continue to report a declining export. Taiwan being the latest entrant in the pack, showing weakness well ahead of any recessionary update from the developed counterparts. IMF sees unemployment rising next year in the US, UK, and Canada, which basically would be the final domino central banks might be waiting for tapping inflation. Another concerning factor is the collapsing money supply, declining 2.4% on year basis in Feb, which is lowest according to the economist. It is kind of a warning for recessions and deflations. So, JK, I'd like to know what's your take on such global financial updates as well as your update on the status of the current economy.
Good morning. Yes, I think last few days we have been, divide of any major economic data from either US or on the European side, excepting the inflation from China yesterday. And in its absence, market has been focusing on the analysis from World Bank and IMF on the global growth prospects and also the developments on the trade, which you mentioned. And of course, the contrasting forecasts from the two world institutions is quite apparent. And what we have seen is that IMF has actually reduced the global growth forecast from 2.8% to 2.9% for 2023, and they expect inflation to slow to 7% this year from 8.5%, 8.7% in the last. And whereas on the other hand, we had the World Bank, which actually reduced the global, increased the global growth forecast by 0.3%, as we mentioned yesterday. And on the US side, the forecasts have been higher at more 1%, whereas the US Fed itself has been forecasting full year growth at 0.4%. So something that market will continue to look at as an ongoing development because inflation is still high, whereas the economy started to face some challenges. So we did see we have been seeing, in fact, a lot of volatility in the US treasuries. We did have move up in the US Treasury yields back above 4% for 2-year, and also the 10-year catching up along with the 2-year after the NFP data last week, which has actually kind of cemented so far the expectation of a 0.25% hike by Fed in May meeting. Of course, today's inflation data will play obviously a very important influence on the scheme of things that we should be expecting. And there was one data that we looked at, that is the National Federation of Independent Business report, which showed some of the biggest tightening in the small business credit availability since 2002. And add to that the fact that what you mentioned as shrinking M2 growth by 2.4% in January, and some analysts look at it as an elephant in the room, and this can have a big dent in the demand going forward, and the inflation is bound to come down in a very speedy manner. That is what is the expectation. There is also another interesting development. The yield on the 3-month treasury is now at 5.08%, which is 1.667% higher than the 10-year, and this is the most inverted yield curve of these two tenors in history. And a year ago it was at 0.7, and 2 years ago it was at 0.02%. That is, I'm talking about the 3-month yield. So 3-month yield has moved up from 0.02% to 5.08%, a massive yield move, and the 10-year yield now is around 3.46%. So this is indicator which Fed has historically followed as a recession foreteller, and now it's almost consensus view that the US economy will get into a deep recession. It's only when and how intense it is going to be. That's the biggest question. Equity markets, of course, grapple with the recession fears going forward. But near term, there is a kickoff in the first quarter corporate earnings. JP Morgan, Wells Fargo, and Citibank, the three major banks, are expected to announce results on Friday. Of course, the equities will also keep an eye on the inflation. We'll have the Central Bank of Canada monetary policy decision today, where they expected to continue the pause which they adopted in the last meeting, notwithstanding the big improvement in jobs market that was seen in the last couple of months. So dollar's recovery against major currencies was short-lived, as currency traders have been discounting a softer headline and core inflation for month-on-month. In year-on-year terms, headline inflation is expected to cool up definitely by a massive 0.8%, whereas for the core year-on-year, it is still expected to be higher by 0.1%, that is from 5.5 to 5.6%. Also on the USD INR, while we did break 82 mark last week, and there were some signs that it could move towards 81 areas, but thanks to intervention from PSU banks initially and subsequent move up due to import demand, we are back above 82 now. Effectively, we remain range bound. And in the absence of consistent flows, rupee gains are stunted, however much the market believes in improved macro fundamentals. So it's a matter of when market is going to start pricing in macro fundamentals. Right now, it does look as if the market is focused on the developments in the global market, particularly in the US, where the recessionary tendencies are worsening. Recessionary prospects are in fact worsening by the day. So on technical grounds, US INR 80 to 20 can initiate further stop loss if it is broken and push the market towards 80 to 50. Also on the growth picture, IMF's growth projection for India for 2023 is now pegged at 5.9%, and for 2024 at 6.2%. And these were earlier projected at 6.1%, that is 0.2% drop now for 2023, and also 0.6% for 2024 as per the IMF projections. So all in all, I think market sitting on their hands waiting for the next big clue on the US economy and also on the inflation. And till then, we will have to contend with some sort of a range trading. Gold, of course, is still stealing the limelight. Now seems to be finding a very strong base below 2000 psychological mark. Thank you.
Okay, Jigar, that was quite good. And yes, folks, our currency USD INR continues to remain in a very tight range. And as JK mentioned, the absence of flows may keep the INR strength stunted with regular interventions from the nationalized banks. But what's quite interesting and keen that the market participants are waiting for is the inflation data from US today, as the eagerness for the market participants to decide on what sort of direction the Fed would take constantly continues to depend on the sort of inflation data we receive. Another major decision would be coming in from the Bank of Canada, which might continue with their stance of pausing rate hike today. So this continues with the additional set of central bank which are now growing towards stance of having rate hikes being at a pause. Another quite interesting thing is to watch out for the inversion of the short-term yield curves, as JK mentioned, but the absence of any such significant data initially has led to a lot many reports coming in from various agencies, being IMF or World Bank, and such reports are in some form and fashion in opposing side. For example, IMF lowering the global growth, whereas World Bank has increased the global growth. So it's gonna stay a bit tricky with mixed sentiments and expectations, folks, but we shall continue to come up with another updates as we continue to do so as of now. Thank you so much for listening, and we shall come back again tomorrow with another round of update.